Something happened overnight that the financial media is not going to explain to you properly. And I need you to pay very close attention, because what I'm about to show you is 4 separate events that all happened within the same 48-hour window. And when you see how they connect, you'll understand why the next 10 days could be the most important 10 days in the precious metals market in decades. First, silver's volatility index just exploded 60% in a single session. Second, a headline is making rounds across Bloomberg terminals and financial media that I believe was designed to move markets. Third, the Shanghai physical silver market is now pricing silver 20% above its own paper contracts. And fourth, the Federal Reserve just injected $16 billion into the banking system through overnight repos, the second largest liquidity injection since COVID. These are not random events. And by the end of this video, you're going to see exactly why they're all connected, and why the timing, 10 days before COMEX first notice day on February 27th, is not a coincidence. Let's start with the volatility explosion, because this is the data point that should have every silver investor's full attention right now. The CME Group publishes a volatility index for silver called COL. It measures 30-day implied volatility derived from options on silver futures. In plain English, it tells you how big a move the options market is pricing in for silver over the next 30 days. When CVOL is in the teens or 20s, the market expects calm. When it hits the 40s or 50s, things are getting interesting. When it breaks above 100, something extreme is expected. As of 2:28 a.m. Central Time on February 17th, silver CVOL hit 115.56, up 42.97 from the previous session. That is a 60% spike overnight, in a single session. Let me put this number in perspective. When silver hit its all-time high of $121 on January 29th, the CVOL was lower than it is right now. Listen to me again. The volatility index is now 10 points higher than it was at the all-time high. The options market is pricing in a bigger move from $74 than it priced in from $121. That means the smart money, the institutional traders, the hedge funds, the banks that trade silver options, they are collectively saying that what's coming in the next 30 days is going to be more violent than the move that took silver to 121. Whether that's up or down, the market doesn't specify. But the magnitude of the expected move is larger than anything we've seen, including the crash. I want to be honest with you. When I pulled up this number at 2:30 in the morning, I stared at it for a good minute. Because this isn't supposed to happen. Volatility is supposed to be highest at the peak, not after a 50% crash. The fact that options traders are more nervous right now than they were at $121 tells me something broke, something fundamental changed. And the market knows it, even if the financial media won't say it. Welcome to the hidden economy. If you're new here, subscribe and drop a like. One click from you helps thousands more see this. Thank you. Now let me show you what else happened in the same 48 hours. A piece is circulating across Bloomberg terminals and financial media this morning, featuring James Thorne, the chief market strategist at Wellington Altus. Thorne originally posted this on X, Benzinga picked it up, and it's now being summarized on Bloomberg terminals. The headline, Bitcoin is a bet on Trump's success. Gold is a bet on America's failure. Let me break down what Thorne actually said, because the headline is designed to provoke. But the substance underneath it is telling you something very important about where institutional money thinks we're headed. Thorne's argument is simple. If you're buying gold, you're betting that America cannot grow its way out of its debt. That the only path forward is print, debase, and hope the music doesn't stop. Gold becomes a verdict, a confession that the system is beyond repair. If you're buying Bitcoin, you're betting that Trump's economic program works, that deregulation, capital redirection, and growth can shrink the real burden of debt without printing it away. Bitcoin becomes the flag of reform. Both assets cannot be right simultaneously. One of them is wrong, and Thorne says the next 2 years will determine which verdict was correct. Now, here's what Thorne didn't say. And here's where my analysis begins. He framed this as Bitcoin versus gold. But he didn't mention silver, and that's the most important omission in the entire piece. Because silver isn't just a monetary bet like gold. Silver is an industrial necessity. Solar panels, electric vehicles, semiconductors, 5G infrastructure, AI data centers, military hardware, medical equipment. Silver doesn't care whether Trump succeeds or fails. Silver is consumed regardless of who's in the White House. It's consumed regardless of whether Bitcoin goes to 1 million or goes to 0. The world needs silver the way it needs water, and the world doesn't have enough of it. So when this narrative frames the debate as Bitcoin versus gold, they're deliberately excluding the one asset that breaks their entire framework. Because silver is both. It's a monetary metal and an industrial metal. It's a bet on America's failure and a bet on technology's success at the same time. You can't fit silver into a neat political narrative, and that's exactly why they left it out. And let me point out something that demolishes Thorne's own argument. Look at what gold is actually doing versus Bitcoin right now. Gold is trading around $5,060, near all-time highs. Bitcoin is struggling around $67,000, down significantly from its highs. If Bitcoin is a bet on Trump's success and gold is a bet on America's failure, then the market is voting overwhelmingly for failure. Central banks bought over 1,000 tons of gold last year. They bought 0 Bitcoin. Sovereign wealth funds are accumulating gold, not Bitcoin. And the gold-silver ratio has been compressing, meaning silver is gaining on gold in relative terms, which historically signals the late stage of a precious metals bull market where silver dramatically outperforms. Thorne says gold holders face steep losses if Trump succeeds, but gold has outperformed the S&P 500, Bitcoin, bonds, real estate, and virtually every other asset class over the past 12 months. If gold is wrong, it's the most profitable wrong bet in the world right now. And if gold is right, if America really is drowning in debt with no way out except debasement, then silver at $74 with a $100 physical price in Shanghai is the single most mispriced asset on the planet. But here's what makes the timing of this piece suspicious. It drops the same week silver volatility explodes to levels higher than the all-time high. The same week, COMEX has 10 days until first notice day with 98 million ounces of registered silver against 400 million in March open interest. The same week, Chinese markets are closed for New Year. And the same week, the Fed just injected $16 billion into the banking system. When Wall Street circulates a politically charged headline about gold being a bet against America during the exact week when silver is showing historic stress, I don't think that's journalism. I think that's narrative management. They're telling gold and silver investors that buying precious metals means you're betting against your own country. That's designed to create shame, to make people hesitate, to slow down the flow of capital into physical metal at the exact moment the physical market is screaming that there isn't enough. Now, let me show you what's happening in China right now, because this is the third piece of the puzzle. Shanghai has 3 different silver contracts. And I need you to pay attention to this because the difference between them is the entire story. One is basically a paper bet, like a futures contract. One is a standard futures contract. And the third one is physical, actual metal. You buy it, you take delivery of real silver, 99.99% pure. Now here's where it gets interesting. The paper contract is trading at $89. The futures contract is at $92. And the physical contract, actual metal in your hands, is at $99.73, a 20% premium over the Western price. Let me make sure you understand what this means. Physical silver in China is trading at $99 when the Western COMEX spot price is $74. That is a $25 per ounce gap. Between the paper price in New York and the physical price in Shanghai, I've been covering precious metals for a while now, and I have never seen a $25 spread between 2 major exchanges on the same metal. This isn't a premium. This is 2 completely different realities existing at the same time. And one of them is lying. And here's the detail that tells the whole story. Within China itself, the physical contract is $10 per ounce higher than the paper contract. The Chinese paper market says silver is 89. The Chinese physical market says silver is 99. That $10 spread inside the same country tells you that physical silver is extremely hard to source, even in the nation that controls 70% of global refined supply. When physical silver trades at a 20% premium to its own paper derivative within the same exchange system, the paper price is lying. The physical market is telling the truth. And the truth is that silver is not $74. Silver is whatever price you have to pay to actually get your hands on it. And right now, that price in Shanghai is $99. Now, why does this matter for what's coming? Chinese markets are closed this week for Lunar New Year. Shanghai Gold Exchange closed. Shanghai Futures Exchange closed. The physical buying machine is offline. And every time China goes dark, Western exchanges have historically used the window to press prices lower. We saw it in previous years. We're seeing it today. Silver is down over 6% as I'm recording this, trading at $72 to $74 depending on the exchange. And let me give you the most extreme example of the physical paper divergence. After the January crash, while COMEX was printing prices in the $60 to $80 range, the Shenzhen Shuibei gold market, which is the largest physical bullion marketplace in China, was selling spot silver at $136.80. And buying silver at $91.60, the selling price was almost double the COMEX price. That's not a premium. That's a completely different market. This is what happens when paper markets and physical markets divorce. The paper market can say whatever it wants, but walk into the largest physical market in the world and try to buy silver at $74. You can't. It doesn't exist at that price. And there's a development that most people covering this space completely missed. China has introduced export controls on silver effective January 1st, 2026. Only 44 companies have been granted licenses to export silver for the 2026 to 2027 period. The system mirrors what China did with rare earths, not an outright ban, but bureaucratic friction that can stretch license reviews beyond 45 days, disrupting supply chains, creating bottlenecks, and giving Beijing a gatekeeping role over roughly 60 to 70% of globally traded refined silver. A local media source quoted an industry insider saying the policy formally elevates silver from an ordinary commodity to a strategic material, under the same regulatory footing as rare earths. When a country that controls the majority of global refined supply decides to treat silver the way it treats rare earths, that is a structural shift in the global market, not a temporary disruption. And I want you to really sit with that for a second. Because most people covering silver are still talking about it like it's just another commodity. China isn't treating it that way. China is treating silver the way it treats the materials that give it geopolitical leverage. That should tell you everything about where they think this is going. And remember Bian Ximing, the billionaire who built a 450 metric ton naked short position on the Shanghai Futures Exchange through Zhongkai Futures? Chinese regulators reportedly froze his ability to add to the position and publicly exposed its size. His short is 450 tons against 318 tons of inventory. If Chinese regulators are deliberately exposing and freezing the largest short position on their own exchange, that tells you Beijing wants the price to go up. They're protecting the long side. They're protecting physical demand. They're protecting their strategic interests. And they're doing the exact opposite of what the CME and the CFTC are doing in the West. Two exchanges, two countries, two completely different approaches. The West is raising margins and engineering crashes to protect the shorts. The East is freezing shorts and restricting exports to protect the longs. Tell me which side you want to be on. And while we're on China, let me address the rumor circulating on social media that China destroyed $800 billion worth of Western silver trades and is considering resuming silver exports globally. I've seen this claim. I cannot independently verify it. What I can verify is that China's export control regime is real. It's in effect, and only 44 companies have been approved to export. Whether China uses these controls as leverage in trade negotiations or as permanent supply restriction, the effect on the global market is the same. Less silver available outside China. Now let me show you what's happening in India, because this completes the global picture. Indian silver prices have crashed 35% from their January peak. In India, silver is now trading at roughly 2,68,000 rupees per kilogram. MCX silver futures have hit what analysts are calling deeply distressed levels. The wholesale hub is witnessing panic-like conditions, with buyers completely absent. That's the Indian MCX market. But here's the paradox. India's silver ETF inflows have been surging. Indian trading firms in Rajkot, 44 of them, declared insolvency from being caught short. Physical demand from India's solar manufacturing expansion continues to grow, and India is one of the world's largest silver consumers. So the paper price in India is crashing while physical demand stays strong. Sound familiar? It's the same pattern as COMEX, same pattern as Shanghai. Paper down, physical demand steady or increasing. The divorce is global. But here's what happens when China reopens on February 24th. They see silver $25 cheaper in the West than in their own market. That's the biggest physical arbitrage opportunity in years. Every Chinese refiner, every industrial buyer, every ETF, every retail investor comes back and sees discounted metal at the exact moment when their own physical market was already showing a 20% premium. What do you think happens to demand? And this is what I'm watching most closely right now. Because if Chinese buyers come back aggressively on February 24th, and first notice day is February 27th, that's a 3-day window where physical demand could collide with 400 million ounces of delivery obligations against 98 million in the vault. I'm not predicting what will happen. But I'm telling you, I've never seen this many pressure points converge in the same week. This is the collision I warned about in my last video, and it's playing out exactly as I described. Now, the fourth piece, the Federal Reserve. On December 30th, the Fed injected $16 billion into the U.S. banking system through overnight repurchase agreements. This was the second largest liquidity injection since COVID. Total repo operations in December reached over $40 billion, and the New York Fed removed the aggregate operational limit on its standing overnight repo facility, meaning there is no longer a cap on how much emergency cash it will provide to banks. Think about what that means. The central bank looked at the banking system and decided that not only did it need $16 billion in emergency overnight cash, but that the existing limits on emergency lending needed to be removed entirely. They're telling us they expect the cash calls to get bigger. The previous cap existed for a reason. When you remove a safety limit, it's because you anticipate needing to exceed it. And this wasn't the first injection. The DCR report, one of the few outlets that actually covered this story, revealed that emergency cash infusions started on Halloween, $51 billion on Halloween, then $17 billion the day after Christmas, then $34 billion on December 28th, then the $16 billion on December 30th. That's over $100 billion in emergency overnight bank funding in 2 months. And each time, the CME Group announced margin requirement changes for precious metals shortly after. Let me say that again. The Fed injects emergency cash into banks, then the CME hikes margins on silver and gold every time, like clockwork. The banks get cash to survive their short positions. Then the exchange changes the rules to push prices lower so the short positions become less dangerous. This is not a conspiracy theory. This is observable. The dates are public. The repo amounts are public. The margin changes are public. You can verify every single one of these yourself. And I'll be blunt with you. Before I started covering this story, if someone had told me the Fed was providing overnight cash to banks specifically to help them survive precious metal short positions, I would have been skeptical. But when you line up the dates, when you see the injection amounts, when you see the margin hikes that follow within days, there's no other explanation that fits the pattern. The data doesn't lie. And here's the connection that nobody is making. The DCR report revealed that JP Morgan, the same bank that stood for maximum silver delivery at the exact bottom of the January 30th crash, is at the center of these emergency repo operations. One of JP Morgan's units disclosed short positions of approximately 5,900 tons of silver it does not own. That's a naked short position that creates unlimited loss exposure if silver prices rise. When silver went from $30 to $121, those short positions required massive amounts of cash to meet margin calls. And when the Fed provides $16 billion in overnight repos to major banks with no cap on future operations, guess who's at the front of the line? The Fed isn't injecting liquidity to help the economy. They're injecting liquidity to keep the banks that are short silver and gold from blowing up. The margin calls are real. The delivery obligations are real, and the cash to cover them has to come from somewhere. As one commentator put it, banks promise to deliver silver they don't own. That's called fraud when we do it. It's called banking when they do it. This is the same pattern we saw in October 2025, when London's silver lease rates spiked to 34.9%. Someone was willing to pay nearly 40% annualized just to borrow silver temporarily. That's not a functioning market. That's a market where institutions are paying any price to avoid a delivery failure. And it's the same pattern we saw on January 30th, when the CME hiked margins twice in 4 days, switched to percentage-based margin requirements, and triggered the largest silver crash in 46 years. The paper price was sacrificed to save the institutions that were short. The crash bought time, but it didn't fix the underlying problem. The delivery obligations still exist, the inventory is still draining, and the physical premium in Shanghai is still 20%. Now, let me connect all 4 dots. Dot 1. Silver seawall at 115, higher than the all-time high level. The options market is pricing in a massive move within 30 days. That 30-day window includes first notice day, Chinese market reopening, and the entire March delivery month. Dot 2. A politically charged narrative framing gold as anti-American circulates across Bloomberg terminals and financial media. This drops during the exact week of maximum stress in the physical silver market. The timing suggests narrative management designed to slow capital flows into physical metal. Dot 3. Shanghai physical silver at $99, while COMEX paper silver trades at $74. A $25 gap and a 20% premium. Physical reality has divorced from paper fiction. And when China reopens, the arbitrage will accelerate metal flows from west to east. Dot 4. The Fed injects $16 billion in emergency overnight repos and removes the cap on future injections. The banks that are massively short silver and gold need cash to survive the margin calls. The Fed is providing that cash because the alternative is a bank failure. These 4 events happened in the same 48 hours, and they all point to the same conclusion. The system is under more stress than at any point since the January crash. And the January crash was the most violent precious metals event since 1980. And here's what I think is really happening. I think the January crash was not a correction. It was a rescue operation. The banks were facing delivery obligations they couldn't meet. The CME engineered a crash through margin hikes. JP Morgan took delivery at the bottom. The Fed provided emergency cash. And now the financial media is providing narrative cover by framing precious metals as a bet against America. This is a coordinated response to a physical shortage that is getting worse, not better. The COMEX has fewer ounces today than it had before the crash. Shanghai has a bigger premium today than it had before the crash. The delivery rate in February is running at 98%. And the volatility index is higher today than it was at $121. The crash was supposed to fix this. It didn't. If anything, it accelerated the problem. Because the crash made physical silver cheaper in the West while demand in the East stayed the same, so metal flowed east even faster. The cure made the disease worse. Now, I want to address something that some of you might be thinking. If all of this is true, why is the silver price going down right now? It's a fair question. And the answer is simple. The paper price and the physical price are no longer the same thing. The paper price is $74 in New York. The physical price is $99 in Shanghai. When you see silver quoted at 74, you're seeing the price of a contract, a promise, a piece of paper that says someone will deliver silver to you at some point in the future. When Chinese buyers pay $99, they're paying for metal, actual silver, in their hands. The paper market can push the price to 50, to 40, to any number they want, because creating paper contracts costs nothing. But the physical market will continue to diverge, because creating physical silver requires mining it out of the ground. And the world is running a 40 to 50 million ounce monthly deficit, and has been for 6 consecutive years. At some point, the paper market and the physical market have to reconcile. Either paper prices rise to match physical reality, or the paper market loses all credibility and becomes irrelevant. Either way, the people who own physical metal win, and the people who own paper promises are at the mercy of exchanges that have already shown they will change the rules, hike margins, cancel trades, and invoke force majeure when it suits them. So here's my assessment as we go into the most critical 10 days of this entire silver cycle. Silver C-Vol at 115 says something massive is coming. The direction could be either way, but the magnitude will be historic. Shanghai physical premiums say the real price of silver is not $74, it's closer to $100. The Fed's $16 billion injection says the banking system needs emergency cash to survive margin calls from precious metals short positions. The gold is anti-American narrative. It says the establishment wants you to feel ashamed for buying precious metals. And the calendar says February 27th, first notice day, is 10 days away. I've been covering this story for weeks now. The Bloomberg memo, the Russia deal, the China crackdown, the corruption data, the $20,000 gold bets, the silver stockpile, the delivery crisis, and now the volatility explosion, the Shanghai premium, the Fed injection, and the anti-gold narrative. Every piece of data, every event, every signal points in the same direction. The physical silver market is breaking away from the paper silver market, and no amount of margin hikes, narrative management, or emergency Fed injections can put it back together. Because you can print dollars, you can print contracts, you can print narratives, but you cannot print silver. This is my opinion, not financial advice. Do your own research, make your own decisions. But the data is the data. CVOL at 115, Shanghai physical at 99, COMEX paper at 74, $25 gap, 20% premium, Fed injecting $16 billion, banks short 5,900 tons, 98 million ounces in the vault, 400 million in March contracts, 10 days until first notice, Chinese markets closed, and a Wall Street strategist telling you on Bloomberg terminals that buying gold makes you anti-American. I'll let you draw your own conclusions. And one last thing, JP Morgan's own research team just published their 2026 silver forecast. They see silver averaging $81 per ounce this year. Let me make sure you caught that. The same bank that is short 5,900 tons of silver, the same bank that took maximum delivery at the bottom of the crash, the same bank that is reportedly receiving emergency overnight cash from the Fed, their own research team says silver averages $81 this year. That's higher than where it is right now. The bank that needs silver to go down is telling its clients silver is going up. Either their research team doesn't know what their trading desk is doing, or they know exactly where this is headed and they're positioning for both outcomes. You decide which is more likely. Drop a comment and tell me, what do you think the CVOL spike is signaling? Crash or squeeze? I want to hear your take. I'll pin the best responses. Share this video with one person who needs to see the Shanghai premium data. Most people have no idea that physical silver is trading $25 above the paper price. That single fact changes everything about how you should think about the silver market right now. If you're not subscribed, hit that button now. I'm connecting dots every day that nobody else on YouTube is connecting. The Bloomberg memo, the Russia deal, the China crackdown, the corruption data, the $20,000 gold bets, the silver stockpile, the delivery crisis, and now this, every day, with data, sources, and analysis you won't find anywhere else. This is the hidden economy. Stay sharp, stay stacking, and I'll see you soon.